Everyone started developing real estate, but primarily it was developed in the sort of southern gateway markets. Commercial real estate, you have to look at the different sectors. There's office, there's retail, there's industrial, and of course, my favorite, multifamily. There is demand. Demand is growing because people are moving to those gateway markets, but there's too much supply. Where we go down the road of everything real estate, including raising capital, flipping properties, building rental portfolios, and of course, my favorite, acquiring and managing value-add apartment complexes. Today, we're talking about the distress in commercial real estate and specifically in multifamily, because of course, that's my favorite. So let's talk more about that today. One of the things I want to kind of start with is just this idea that commercial real estate is going to experience so much distress, and there's so many problems with commercial real estate. The truth is, you can't just say commercial real estate is in distress. The truth is that office buildings in commercial real estate are in distress. And truly, the kind of virus that exists around office is the work from home, work remote, work hybrid model that, of course, was kind of founded in COVID, where nobody went to the office. And so what that's resulted in is that because nobody's going back to the office, most employers are scaling down their footprint for how much office space they need. That is number one. So if you're looking at, okay, how do we talk about commercial real estate? You have to look at the different sectors. There's office, there's retail, there's industrial, and of course, my favorite, multifamily. One of the good things that is happening in commercial real estate, specifically with office, is that some of the office is being repurposed. And there are a number of office to residential conversions happening, especially in the urban core. So they're finding ways to kind of convert these office buildings that they know are not going to be performing as office complexes anymore. And they're trying to convert them into residential space because people still want to rent apartments. The second big piece, right, that I want to make sure that we explain today is that when it comes to multifamily commercial real estate, over the last really 5 years, since 2020, when interest rates went basically to zero, and you could borrow money for commercial real estate, especially for apartments, at 3 and 4 and 5%, everyone started developing real estate. But primarily, it was developed in the sort of southern gateway markets: Phoenix, Houston, Dallas, Austin, and Orlando. So when that happened, supply boomed. And what happened is that over the 2021, 2022, 2023, a lot of those new construction units came online. And what that did was it put pressure on all the existing apartment complexes that were there, because there was so much new inventory, so much supply, that prices for rent were stagnant. So if you look at the Journal of Consumer Affairs, if you look at data from Cushman and Wakefield and Marcus and Millichap, and you look at those gateway markets, they've essentially had flat rent for the past 3 years. 2023, 2024, and of course, early part of 2025, rents are essentially flat. Why? Supply and demand. There's too much supply. There is demand. Demand is growing because people are moving to those gateway markets, but there's too much supply. And so because of that, rents are stagnant. So if you got involved in a development, maybe a multifamily syndication or a multifamily value add deal, or you're a sponsor or you're a limited partner and you invested in one of those deals in 2021, 2022, 2023, and you were betting in your pro forma, you were betting in your underwrite on the rents going up 5%, 8%, 10%, 15%, you've basically had zero rent growth. And so the value of your complex is not going up anymore. All the while, everything underneath, meaning the cost of your debt is going up, The cost of insurance is going up. The cost of your labor is going up. Cost of materials is going up. Cost of your property taxes is going up. And so the value of the building is actually going down because the net operating income is going down. Okay? So again, my first big point here is you can't just say that commercial real estate is in default or commercial real estate is experiencing defaults. The truth is, yes, but that's mostly in office. Okay? Second thing is that after 2023, when a lot of these new complexes were built and then all of a sudden interest rates started going up, again, according to Cushman and Wakefield, over the last 12 months, new multifamily starts are actually down 36%. So you're actually starting to see construction halts, construction stops, which means you have this kind of supply shock that's happening in the marketplace. Well, all of a sudden, a lot of that inventory that was built in 2021, 2022, 2023, a lot of that inventory has now been absorbed into those markets. And now there's not a lot of new supply being built. Okay. So that's another big point of what's going on in multifamily and what's going on in commercial real estate. Number three, multifamily, because there's less supply, okay, and again, because there's this very expensive single family homes out there, okay, single family homes have gone up in value. I mean, in some cases, 80 to 100%. They've literally doubled in value over the last couple of years. They've gone from a house that was worth $300,000 is now worth $600,000. A house that was worth $600,000 is now $1.5 million. Okay. Renting an apartment today is still 35% cheaper than owning a home. The payment on a single family home, about $2,400 a month. The payment on a comparable rental property, only about $1,700 a month. Okay. So about 35% more expensive to actually buy a home. And that doesn't even include your down payment. I'm just talking about the monthly payment alone. So because of that, people will still want to rent. So where does that leave us? Where does my analysis put us? Well, where does that put us is that now that a lot of that original supply from 2021, 2022, and 2023 has now absorbed, and now there's these construction halts happening because, again, interest rates are so high, it's too expensive to build. The cost of materials too expensive. Plus, there's these tariffs. It's too expensive to build. Construction has essentially slowed down by 36%. Now, all of a sudden, you're going to have some supply shock and you're going to have more demand than supply. And when that happens, rent rates are going to go up. That's the next step for us. That's what's going to happen in the back half of 2025 through the end of 2026. Because there is not going to be a tremendous amount of new construction. There's not going to be a lot of new permits. There's not going to be a lot of new building. Of course, there's some construction already happening because it was permitted and started months or years ago. But going forward, okay, there just isn't going to be that much new construction. So there's going to be this supply shock, which means rents are going to start to go back up. Okay. Now, in addition to all those kind of things, what's happened is because there has been some default, even in multifamily, there's been some default in obviously in office, a lot in office, but there's been default even in retail and industrial because of interest rates going up so high so fast. Banks are sitting on hundreds of billions of dollars of default. Okay. Hundreds of billions of dollars of properties that they're basically doing workouts. They're doing loan modifications. They're rearranging loans and loan terms to make sure that they can work out those deals and they don't have to mark down those assets as a loss on their balance sheet. Because if they have to mark them down, obviously that shrinks liquidity. It shrinks their balance sheet, which shrinks the amount of money that they can lend. Okay. But let's not get too overly excited about all the stuff that you see on the popular news and the fear porn about all the defaults coming in commercial real estate. There's definitely some defaults coming. I've seen it. Okay. I bought a 28 unit that was in foreclosure. I'm currently in the process of closing on a 293 unit that is teetering on foreclosure, to where I know for sure the owner is not paying the mortgage. So they're accruing default interest. There's another 404 unit that's in default, right? The rumor is it was previously worth 30 million and now it's going to trade for less than 10 million. And those are just some of the deals in my market. So there definitely is default. It's definitely happening. But if you look at the grand scheme of all the properties that are out there, especially multifamily properties, especially in areas where they're not in boom bust markets. Okay, when you look at the coastlines and you look at the Sun Belt, you look at areas like along the East Coast, along the West Coast, and places like Orlando and places like Dallas and Austin and Houston and Phoenix and Vegas. Those are boom bust markets. Okay? They boom when interest rates are low, and they bust when interest rates go up. It's the same thing that happened in 2004 through 2007. It's the same thing that happened in 2021 through 2023. Boom, because interest rates are low, and bust, right? Essentially, as soon as interest rates go up or there's liquidity that's taken out of the market, which is what happened in 2008. Those are boom bust markets. Well, you look at places in the Midwest, specifically like Cleveland, where I operate, where we have, almost 2,000 units. Okay, I don't want to let the secret out of the bag, but in Cleveland, in the tier 1 and tier 2 suburbs, there almost is no new supply, right? And if there's no new supply, what does that mean? Well, that means that there's still demand, especially people that want a renovated, value add, renovated B-class apartment complex in a very safe, low crime area, where they can easily get to work. They can easily go to the hospital and be a nurse, or go to the hospital, be a doctor. They can easily get to the school and be a teacher. They can easily get to work and be in sales, and they can rent an apartment. Well, the truth is that those kind of deals that have little or no competition, okay, because there is no new construction. There's also, what I found is like, look, we sell construction in our business. We sell construction. I can actually do construction for other owners. And we've called and talked to dozens and dozens, if not hundreds of multifamily owners. And most of them are not doing a value add improvement to their apartment complexes. They're not doing a big turn. Okay. They're not doing a big turn to their apartment buildings. Okay. They're just doing make readies. They're leaving them in classic condition. They're doing make readies and renting them back out. And so we find that we have an unbelievable strategic advantage in those tier 2 suburbs, where we're taking classic units from legacy owners, and it's a convergence, guys, of all of these things working in our favor. Number one, there's no new supply being built in the tier 2 suburbs. It's all being built downtown Cleveland, or it's all being built way out in the tertiary suburbs. There's nothing happening in the tier 1 and tier 2 suburbs. That's number one. There's no new supply. Number two, most of the units are still in classic condition. Number three, we're one of the few companies that are renovating and improving, basically putting in all new kitchens, all new baths, all new LVP flooring, LED lights, new faucets, new countertops, new ceiling fans. Nobody else is doing that. So what it's allowed us to do is play in this middle market, this B-class market, and have the nicest units in these B-class areas. The nicest units, even though they might be C-class properties because of their age, their vintage, we have the nicest units now because they're improved. Okay? And so because of that, we've built this amazing portfolio. And now, as these new defaults are happening, the brokers are bringing those deals to us. The brokers should be bringing those deals to you on market and off market, right? To buy them, renovate them, and then put new debt on them 3-4 years out. As long as you're raising the income and you're renovating the units and you're increasing the rent, you're going to get a higher valuation and you'll be able to refinance and then put long-term debt on it because you have so much more income. Okay. And so there is going to be, as I said yesterday on our live coaching call with my Forever Passive Income Mastermind members, we talked about when are the defaults really going to happen. The truth is that when interest rates went up in 2022, it took about 2 years for operators to feel that pain. Okay. It took almost 2 years for operators to feel that pain. So 2024, the defaults started to happen. 2025, there are even more defaults happening because, again, taxes are up, insurance is up, the cost of debt is up, and people haven't pushed their income up for all the reasons I already mentioned earlier. Okay, they didn't renovate their units, they waited on the market, and now the market has not pushed the rents up, primarily because there's all this new supply. So what's happening now is that because of these reasons, higher taxes, higher interest rates, their income is not up for most operators, and the cost of all this inflation. Well, what's happened is all that it took about 2 years to start to show its ugly face. And that happened in 2024. There weren't defaults in 2022 or 2023. Those defaults began happening in late 2024. Well, if you look at 2007 as an example, in 2007, when the defaults happened, it took almost 3 full years, all the way into 2009, 2010, for those defaults to hit a trough. Basically, for prices to hit a trough, for all the defaults to basically be identified, and then for those defaults to be sold, and for new buyers to come in and buy those assets, and for new buyers to come in and turn those assets into cash flowing assets. And so where we're at right now, we're about 9 months into the default. We still have about 2 years to go. So what that means is that if you own a building like we do, our buildings where our income, you take Valley Park and Plaza, for example, when we bought it in 2022, it was only making $100,000 a month of income. Now it's making $150,000. If you look at Brookside, the Brookside portfolio that we own, when we bought it was making about $150,000 a month. Now it's making $205,000 a month. Okay, we're not yet at pro forma, but we've had a significant value add, a significant growth in the income. If you've done that, you're not going to have a default. Okay, but most people haven't, right? They bought the building, it was making $200,000 a month, $2.4 million a year. The rents are stagnant, they're not turning units, and the income is stagnated and still at about 2.5 million a year. The income is maybe up 1 or 2 or 3%. Well, you're not really driving any new value if your income is only up 1 or 2 or 3% per year. Okay. So now those people have been able to continue to manage the building without distress because they still have income. But as insurance costs goes up, inflation goes up, interest rates go up, cost of labor goes up. They're not turning their units. They don't have any leftover cash. What I'm now seeing is operators who, some of them are quote unquote gurus who are actually marketing on Facebook and Google and Instagram, and they're running ads to recruit new money into a fund. And all they're doing is using that money in a fund to basically fund their defaulted assets. And it says in the fine print on the ads and on their private placements that this money could be used to essentially stabilize or refinance an existing asset. All it is basically a capital call. They're not actually buying new assets. They're not stabilizing new assets. They're not renovating anything. They're just replacing expensive debt. It's essentially a capital call. And if you look at the fine print, that's where that money is going. Don't get caught in that. Make sure you read the fine print. Make sure you ask the sponsor or the fund manager or the general partner where exactly is this money going? Is it going into a new acquisition, or is it going into a capital call for one of their bad performing assets? Okay. So those are some of my big takeaways right now, right? Number one, you can't just say commercial real estate is in trouble, because it's not. None of my stuff is in trouble. What you can say is that office, because of this work from home virus, is causing a lot of defaults in the office sector. That's obvious. Number two, supply starts are way down, 36%, according to Cushman and Wakefield, which is going to create some supply shock, and actually rents will start to climb because there's not a lot of new inventory coming in 2026 and 2027. Okay. Also, it's still cheaper to rent an apartment than it is to buy a home. Okay. We're starting to see some prices coming down, especially in Florida, because the cost of HOAs, the cost of taxes, the reassessments of condos, prices are coming down. Well, good. Finally, we needed that. Okay. And so you are going to see some distress. You are going to see off-market deals. So it really still comes down to building relationships with brokers. The brokers that originally sold these assets back in 2019 through 2022, 2023, those are the same brokers that are going to work with the owner and relist and sell these assets, but now at a discount. Okay. At less than what the last guy paid. Okay. And if a realtor or a broker just keeps telling you, and we talked about this yesterday on my mastermind call with my coaching, they said all these agents just keep saying everything's going up and to the right, up and to the right, up and to the right. Well, sorry to tell you, but if you don't have more income and you have more expenses, the properties can't just keep going up and to the right because they can't get financed. There's not enough income to cover the debt service. So they can't keep going up and to the right if the income is actually going down because the rent is stagnant and the expenses are going up. It can't happen. So Robert's one of our, coaching students and mastermind members, has said all these, brokers and realtors are just saying it's going up and to the right. And he's like, no, it's not. It's going to be defaulted. It might take, again, we're about 9 months into it right now. It's going to take another 2 years, especially in the Sun Belt, especially along the East Coast and the West Coast, especially in these boom bust markets. It's going to take another 2 years, and you're going to see more default, more distress. I'm seeing more and more and more like Marcus and Millichap and Colliers and CBRE hosting webinars and Zoom calls talking about default, distress, and receivership. So, if the brokers are talking about it, it's coming. Okay. Especially from the big boys, guys like Marcus and Millichap and Cushman and Newmark, they're hosting webinars on it. So don't listen to the residential realtor, the residential broker who says, yeah, it's up and to the right. It's up and to the right. Property's going to keep going up. That's the same stuff they said in 2007. It's the same thing they said last year in residential in Florida. It's going to keep going up. Not really. No, it's not. Prices in Florida are coming down. Okay. The amount of inventory is going way up. Okay. So prices are coming down. So those are my big takeaways on today's market, right? It's not fear porn. It's not the, latest attention grab. It's not telling you, oh my gosh, you should freak out. Not at all. What I am here to say is that if you're turning your units, if you're improving your buildings, if you're raising your income, you are going to make it just fine. And there's going to be defaulted assets that you can scoop up for pennies on the dollar. How do I know? Because that's what we're buying. We just bought a 28 unit. We're buying a 293 unit. We have our eyes on a 403 unit. We've got a bunch of stuff that we're evaluating that's in distress. Right? So I'm in it. I see it every day. All right, guys. So that's my take on what's going on in the market. Like this episode and like the conversation, please like, subscribe, and we'll see you on the next episode of Accelerated Investor.